Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiro Dadia. We have with us Mr. Kun Go, Head of Asia Research, ANZ economist and forex strategist joining in. Welcome to the show, Kun, and always a pleasure to get insights from you. Kun, my first question coming to you is, overall, from an economic development perspective, how big an impact are you seeing on the back of the geopolitical crisis between Russia and Ukraine?
The most immediate impact is the soaring oil price and also the increase in wheat prices as well. Russia obviously is a major energy exporter, and Ukraine is a huge producer and exporter of wheat. And it's not surprising that we've seen prices for those rising very, very sharply. So that has a huge immediate impact on the global economy through higher prices, which will erode consumers' purchasing power. That in itself will reduce global GDP growth. In addition to that, given that the sanctions that have been imposed by the West on Russia, we're going to see an impact of that as well. Now, obviously, the impact will be far larger on the Russian economy. I think it's fair to say we're going to see a deep recession in Russia now as a result of that. But Europe will also feel the impact of that as well, given that there is quite strong trade ties between Europe and Russia. So it's fair to say we're going to see a reduction in European growth as well. I don't think at this stage it's going to push them into a recession, but definitely slower growth than what we were expecting prior to the recent geopolitical events.
Right. So with everything said and done right now, overall, a couple of things that everyone was watching out for is in terms of liquidity tightening that's happening in the US, the kind of decisions that Fed would be taking, and its counter impact in terms of emerging markets. With this, you have the geopolitical tensions that have come at play as well. So if you have to look at both of these aspects, how are you viewing the dollar index?
Well, US dollar index, as proxied by the DXY, has risen on the back of the Russia-Ukraine conflict. That's largely because the euro has come under pressure, and that's to be expected, partly due to safe haven flows into US treasuries, but also the fact that, as I said earlier, there's going to be a more significant impact on European growth. That means the ECB will most likely have to continue to provide ample liquidity, and any thought of the ECB turning more hawkish, I think you can pretty much forget about it for the time being. So that has caused euro to weaken, and it's broken a key 111 level, and it looks like the next major level, support level, will be about 110. If that breaks, then there could be further downside for the euro. And given that the DXY index is made up of 50% the euro, it's no surprise that the DXY has been higher. But outside of weakness in the euro, we actually haven't seen material weakness in the other major currencies. If you look at it in Asia in particular, the Chinese yuan has remained extremely strong, and in fact, most other Asian currencies have actually shrugged off their rising uncertainty that was caused by the conflict. So at this stage, most of the pressure is actually being brought to bear on the euro and not wider than that at this stage.
Right. So would it be right to say that markets are still taking a very cautious view about the current situation, and there's certainly no indication of risk getting put back?
Our investors are certainly still cautious. After all, we don't really know how long further this conflict will drag on. The US and Europe have indicated that they're prepared to impose even further sanctions against Russia. And we are not quite sure what Russian President Putin has in mind in terms of further retaliation and how much further he wants to escalate things. So there's still a huge amount of uncertainty out there. Now, having said that, risk assets have actually navigated the past week fairly well, I must say. I mean, we did see equities getting sold off initially, but we haven't seen a huge amount of follow through selling. It's more or less stable, I guess, as markets assess that a wider negative impact on growth at this stage is probably or can be contained, that it's not going to push the global economy into a renewed downturn.
Right. And overall, if you see in terms of the kind of pressure that we're seeing, as you mentioned as well, the yuan is still standing out for its resilience. Even if global markets are reeling from Russia's attack, how do you see the yuan from here on?
The yuan is still very much supported by China's strong trade surplus and also the structural portfolio inflows going into Chinese assets, in particular the Chinese government bond market. And given the sanctions that US and Europe have imposed, and in particular the freezing of the Central Bank of Russia's FX reserves, I think over the medium to longer term, that might actually encourage other central banks to consider moving or reducing their reserve allocation in dollars or even euros. And I think China offers a good diversification alternative to that. So foreign central banks have already been increasing their allocation towards the yuan in recent years. I think we'll probably see that move accelerate. And on top of that, we have ongoing index inclusion related buying, which will ensure that China will continue to receive $10 to $15 billion of inflows into their bond market every single month. So those are helping to keep the Chinese yuan fairly well supported at this stage. And as long as the Chinese exports remain strong, I believe that the yuan can continue to maintain its current strength.
Right. And overall, if you see in terms of where the Indian markets go, especially from a crude perspective, I mean, crude has touched the roof. How big an impact will that have?
I think the biggest direct impact on India would be the high oil prices on India's external position. Now, whilst economic recovery is ongoing in India, which is positive, the trade deficit has already deteriorated. And therefore, the starting point is not favorable. Add on top the recent spike in oil prices with Brent over $110 a barrel. That's going to put tremendous pressure on India's trade deficit. And hence, it's very reasonable to conclude that India's overall current account deficit will significantly widen this year. Now, ordinarily, that is negative for the rupee. On top of that, inflation pressures, which have already been quite evident, will continue to build, and you'll see inflation starting to rise and once again threaten the top of the RBI's inflation target band. So I think the overall forces suggest that there's going to be further downward pressure on the rupee. But I don't think the rupee is set to sell off massively. The RBI, after all, has managed to amass a very large FX reserve war chest in recent years, which they can deploy to smooth any currency volatility. In addition to that, foreign investors are still hesitant to short the rupee, given that the carry cost is quite prohibitive. So if anything, I believe that rupee weakness will mainly stem from the deterioration in the external balance, offset slightly by still fairly strong FDI inflows and portfolio flows into India. So net on net, I think I'm forecasting further weakness in the rupee, but nothing too material.
Right. And overall, if you see in terms of where current markets are concerned, what would the strategies be that you would recommend?
Look, in the FX space, obviously safe haven currencies have benefited, but I don't think that will last for too long. I think we are banking on the view that eventually we will see a de-escalation. Hopefully, I'm right. And if that happens, then we should be returning back to sort of the pre-conflict trends, which is the Fed will continue to hike rates, but that doesn't necessarily mean the dollar will rally. I think the dollar will start to lose some of the safe haven flows and start to weaken again. I think the commodity-linked currencies, I think, should do well. So even though energy prices should come off, they'll still stay elevated, given that the conflict, I think, has altered the whole geopolitics around energy. And I think Europe in particular will continue to cut their reliance on Russian energy, which means they will look for other alternatives, and that will keep overall energy prices high and stuff. So that should benefit commodity currencies like the Canadian dollar and the Australian dollar in particular. Over in Asia, easing of tensions should see global growth recovery continue. And in this part of the world, we have countries continuing to ease restrictions, open up their borders. And ultimately, that's very positive for the domestic demand recovery, which will be very, very positive for currencies, particular Thai baht in particular, which is going to benefit from a return of tourism flows.
Right. So overall, that's the view coming in. Thank you, Kun, so much for joining us on the show. Always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
You're welcome. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.